Imagine this. The U.S. government doesn't just hand out money, but actually demands a piece of the company in return. Well, today, August 19, 2025, that's pretty much what's happening, a really significant proposal just rocked the business world. The Trump administration, specifically Commerce Secretary Howard Lutnick, announced this plan to convert up to, what, $10.86 billion?
That's the number, yeah. $10.86 billion in SHGPS Act grants.
Right, grants for Intel.
Yeah.
But converting them into a 10% non-voting equity stake.
Non-voting, yeah. That part's important.
It is, but still,
yeah.
This isn't just about grants anymore, is it? It's being framed as this strategic crossroads for U.S. tech leadership.
Definitely. It's explicitly linking Intel's survival, you could say, directly with national security.
And the market reacted instantly. Intel's stock jumped 7.5%.
Right after the news, yeah. A significant bump.
But here's where it gets, well, really interesting. This is not just a simple business deal.
No, far from it.
Some are calling it smart taxpayer protection, getting a return. But others, they're using words like shakedown, extortion.
Even communism, which is quite a strong reaction.
Exactly. So let's unpack this, because it's way bigger than just Intel, right? This feels like a major test case for how America handles that tricky intersection of capitalism and national security.
Mm-hmm.
Today, we're diving into the history, the motivations, and what this all could mean for the future.
And it's fascinating because while this specific proposal feels maybe new in scale, the core idea of government stepping in, it's not entirely new. But the reasons why now, and the global context, that makes this feel, well, like a really high-stakes deep dive. It really highlights a potential shift in industrial policy.
So that's our mission today. We want to explore the history, the motivations, the pros, the cons when governments take equity stakes. We're using the sources you've shared with us, looking at arguments, historical examples, and really trying to understand what it means for you, the taxpayer, and the economy.
That's good.
Okay, so let's start with the why. Why would a government even want to become a shareholder? What's the thinking behind it?
Well, connecting it to the bigger picture, governments usually step in for a few key reasons. First, and this seems really central to the Intel situation, is national security. Strategic imperatives.
Right.
The government sees companies like Intel as basically too critical to lose.
Yeah.
For maintaining technological sovereignty.
Keeping that edge over rivals.
Exactly. Yeah. Keeping the edge, especially against foreign competitors. They want some influence maybe over R&D, supply chains, big decisions, really aiming to reduce reliance on foreign manufacturing.
So it's a big shift in policy then?
It's being called a seismic shift, yeah. Very different from just letting the market handle everything.
Okay, national security. What else?
Another big one is getting a return on the taxpayer's investment.
Oh, okay. The money aspect.
Right. Some officials argue, look, if we're putting in billions of taxpayer dollars, shouldn't we get some potential upside, not just free money?
Like a piece of the action.
Precisely. If a company does well because of that public money, the public should potentially benefit financially too. It adds a layer of accountability.
Makes sense. Anything else?
Yeah. Sometimes it's about broader social goals, like pushing companies to keep jobs, maybe keep prices low for consumers, even if that clashes a bit with pure profit maximization.
So a double bottom line, kinda.
That's the term, yeah. Balancing social aims with financial ones. And sometimes, maybe less relevant here, but in developing markets, the state steps in to fill institutional voids, providing capital or coordination. The private sector just wouldn't.
Okay, those all sound like, understandable reasons on paper. But the sources you shared, they also bring up some pretty sharp criticisms, especially from, say, a more conservative perspective.
Yeah, absolutely.
What are the big worries? Because it doesn't sound like everyone thinks this is a great idea.
No, not at all. And it really raises that fundamental question. Does government ownership actually work well in practice? Historically, the general view among finance folks is pretty clear. Privately owned businesses are more efficient and profitable than governments.
Okay.
And that government ownership tends to have a negative influence on companies. The research points to some major problems.
Like what?
Well, the number one concern is usually political interference. Decisions getting distorted.
Oh, so?
When the government holds equity, there's a real risk that political criteria tend to dominate over economic criteria.
Meaning?
Meaning Pressure to prioritize things like national security, sure, but also maybe just maintaining employment in a certain district, even if it hurts the company's efficiency or profitability.
Okay. Politics over profits.
Exactly. And Alitalia Airlines comes up a lot as an example here.
The Italian airline.
Yeah. The sources mention how the Italian government owned nearly half of it, and that led to it being, frankly, an inefficiently run airline. You had common strikes, resistance to potentially more efficient takeovers by airlines like Air France or Lufthansa, fear of job losses, union power. So the government kept propping it up, funding sizable monthly deficits instead of letting, a tougher but maybe more economically sound decision happen. It's hard for politicians to make purely business calls when votes and jobs are involved.
Right. I can see that tension.
And that political influence often leads directly to, well, lower efficiency and profitability.
Is there data on that?
There is. A study from Purdue University by Katarina Holland looked at this over 25 years, from 87 to 2013. It found that when the market suspected government investments had possible political motivations, shareholders reacted skeptically. The result: estimated losses of $14 billion across those companies.
Wow, $14 billion.
Yeah. And the study also showed that these companies, the ones targeted by politically motivated government investors, actually saw declines in their size, profitability, and efficiency about 5 years later.
So shareholders basically anticipate problems.
They often anticipate that political goals are just going to clash with maximizing their own wealth. It makes sense, right?
Yeah, it does. What other issues come up?
Another big one is something called soft budget constraints.
Soft budget constraints.
Yeah. Basically, when a company knows the government is backing it, maybe has an equity stake, it doesn't face the same hard financial discipline.
Like they know they'll get bailed out.
Exactly. They might get easier access to capital. They're less likely to face bankruptcy. Which sounds good, but it can lead them to approve bad investments or keep funding failed projects.
The too big to fail idea again.
Pretty much. It creates moral hazard companies taking risks they wouldn't otherwise take because they don't bear the full consequences if things go wrong.
So it's like the government backing removes some of that crucial market discipline.
That's the argument, yes. It can undermine the very forces that usually drive efficiency. We also see issues with controls, like trying to limit huge executive payouts, those golden parachutes.
Do those controls work?
Historically, the sources say they've been pretty ineffective. Companies just find myriad ways to get around them, other benefits, different kinds of compensation. It becomes a sort of cat and mouse game.
Always finding loopholes.
Pretty much.
Yeah.
And finally, there's the risk of crowding out private investment.
How does that work?
Well, if you're a private investor, seeing the government as a major shareholder might make you nervous, right? You worry about political interference, shifting goals.
Getting tangled up in politics.
Yeah, so it might deter private capital that would otherwise flow into the company. Even if the shares are non-voting, like in the Intel proposal, critics argue there's still indirect influence.
Yeah.
And it could dilute profitability, making it less attractive.
And some critics take it even further, right? Using some strong language.
Oh, yeah. Some call these moves shakedowns, extortion, even graft. Really serious concerns about funds potentially being misused for political gain or, worse, personal enrichment.
And you mentioned online comments.
Yeah, looking at some Reddit discussions on this Intel proposal, you see really strong opposition. People calling it communism, sometimes maybe sarcastically aimed at the GOP's perceived shift or mob-style profiteering. Yeah, fears about governmental stock manipulation or the money just disappearing into a dark money hole with no accountability. Really visceral reactions from some quarters.
Okay, so those are some very serious criticisms, highlighting major potential pitfalls. But as you said, it's not completely one-sided. The sources also show why proponents argue for government equity.
That's absolutely right. Despite all those risks, there are justifications put forward.
Like what?
Well, a key one we touched on is protecting the taxpayer and getting a potential return.
Right, the Chrysler example.
Exactly. The Chrysler bailout is often cited. The government got warrants, basically, options to buy stock later, and when Chrysler recovered, the government exercised those warrants and reportedly made over $300 million profit for taxpayers.
So the argument is, it's fair.
Proponents say it's a fair approach. If taxpayer money helps turn a company around or boost its value, the public deserves a share of that upside, rather than just giving free handouts.
Okay, fair enough. What else?
Then there are those big strategic national imperatives we talked about, especially for critical industries like semiconductors.
Right. technological sovereignty.
Exactly. Reducing reliance on foreign suppliers like TSMC and Taiwan for these incredibly advanced chips, the 2 millimeter and below kind. Intel is seen as vital for that.
So the equity stake helps ensure that happens.
The thinking is that direct government investment, maybe with an equity stake, helps secure that domestic capability. It can also stabilize a company's finances, provide a buffer against market volatility, and maybe accelerate really long-term R&D.
The kind of research private markets might be hesitant to fund.
Precisely. Especially R&D with long horizons or uncertain payoffs, but which is vital for national competitiveness down the road. Government capital can bridge that gap, insulating it a bit from short-term shareholder pressures.
So putting this in perspective, this isn't the absolute first time the U.S. government has gotten involved like this, right?
Not entirely, no.
Yeah.
History does offer some parallels, though maybe with different motivations.
Like the 2008 crisis?
Exactly. The 2008 financial crisis was a huge moment for this. The government injected massive amounts of capital into automakers GM, for instance, and lots of banks through TARP, the Troubled Asset Relief Program.
And they took equity stakes then, too?
Often, yes. Warrants or direct equity. But the main goal there was financial stabilization, stopping a total collapse. It was less about the kind of long-term strategic national security focus we're seeing debated with Intel today.
That crisis also brought up the executive pay issue again, didn't it?
Oh, absolutely. Huge public debate about bonuses and compensation at firms getting bailouts.
And looking globally, is this common?
Well, state capitalism isn't new, but it has evolved. It's not always just the government owning 100% of a company anymore, like the old state-owned enterprises or SOEs.
How has it changed?
We see these new varieties now. Governments might work alongside private investors, taking majority or minority stakes, or just providing strategic support. These hybrid models are actually becoming much more central to the global economy.
Does it work better in some places than others?
Success really seems to depend heavily on the country's institutional environment. Things like having a professional, capable government bureaucracy that can resist political meddling and strong checks and balances. Without those, the risks we talked about earlier become much larger.
Okay, so let's bring it back to today, to Intel. This specific proposal is really sparking a firestorm, isn't it? Strong feelings on both sides.
Absolutely. It's a live case study of everything we've just discussed. The reactions are really divergent.
So you have the proponents.
Right, like Commerce Secretary Lutnick. They see it as crucial for national security, essential for getting those advanced chips made in the U.S., and as a way to ensure taxpayers get a potential return on investment. They frame it as simply fair.
Compared to just giving the money away.
Exactly. Compared to free handouts, they're tying corporate success directly to national interest.
And then the critics.
A lot of pushback there, including, interestingly, from some people reportedly involved with the GDS Act itself.
What are they saying?
They're using that strong language again. Shakedown, communism, extortion, graft. Their core argument is that the real return on investment from chips isn't a financial dividend for the government.
It's the chips themselves.
It's the national security gain, the economic benefit of having a robust domestic chip industry. That is the return. They worry this equity idea introduces unnecessary financial motives that could actually hurt those goals.
How so?
They raise the risk of governmental stock manipulation. Potential conflicts of interest, like what happens if the government owns a chunk of Intel. But Intel's rivals also need chip piece funding. And generally, they fear it could derail national security imperatives, just to chase what might be pretty small financial returns in the grand scheme of things.
Even with non-voting shares.
Even with non-voting shares. The concern about indirect influence and political pressure remains.
Yeah.
Just having the government as a major shareholder changes the dynamic, critics argue.
Okay, so if direct equity stakes are this complicated, this fraught with potential problems, are there other ways? What alternatives does the government have if it feels it needs to intervene in a strategic industry or during a crisis?
Yeah, that's a crucial question. And there are several alternatives, often more market-oriented, that aim to achieve similar goals without the baggage of direct equity.
Such as?
Well, one idea relates to buying assets, maybe distressed ones. Instead of taking equity to try and recoup value if you overpay, you could use modern auction theory.
Auction theory, how would that help?
The idea is to design auctions that encourage sellers to bid competitively, revealing the true market price. So the government pays a fair price up front, reducing the need to get value back through ownership later.
Interesting. What else?
Warrants. We mentioned them with Chrysler. Instead of common stock, the government warrants those options to buy stock later, often deep out of the money.
So potential upside, but no control.
Just exactly. Taxpayers get a potential financial upside if the company thrives, but without the government getting board seats or direct management control. It avoids a lot of the political interference worries.
Okay. Any other tools?
For homeowners or companies needing loans, you could structure the loans differently. Maybe much longer terms, like 40 years, or build in upside options for the lender, the government. Again, providing support without direct ownership.
More indirect approaches.
Yeah, sometimes the best intervention isn't financial at all. The government could focus on providing better information, like expanding reliable economic data, maybe a universal Case-Shiller home price index, or investing in infrastructure, like public transport. These things can boost the economy systemically, helping industries without picking specific winners or taking stakes.
And what about that temporary nationalization idea?
All right, some countries, Sweden is an example, have done this in crises, particularly with banks. They nationalize temporarily, stabilize the institution, but with a very clear plan to privatize it again once the crisis passes and markets are stable. It's strong control, but with a defined exit.
So quite a few options on the table, it seems.
Definitely. Each with its own pros and cons, of course.
Well, we've certainly navigated a complex world today where government and private business collide. What seems really clear from our deep dive is that this Intel debate, it's not just about grants or stock percentages.
No, it's not.
It taps into this fundamental tension in our economic philosophy, a tension that, as you've shown, has played out many times before.
Absolutely. And what this deep dive really illuminates, I think, is that while the intent behind these government equity ideas often comes from a genuine place, national security, taxpayer protection, the execution always runs into that inherent conflict, that friction between market efficiency and, well, political goals or pressures.
And the Intel case is the latest chapter.
It really is. It's a test, maybe, of whether this non-voting structure can actually navigate those historical pitfalls, or if the simple fact of government capital being involved fundamentally changes the game, regardless of voting rights.
So as you, our listener, think about this deep dive, maybe ask yourself this. In today's world, with global competition intensifying, where should we draw the line? Is there a perfect balance between strategic national interests and free market principles? Or are these forces always going to be in some way pulling in different directions?